Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in 30 minutes. Let's get to the stories we're following out of the BNN Bloomberg newsroom. Oil prices are on the rise again today after conflicting statements from Iranian and U.S. officials reduced hope for progress on ending the conflict. The U.S. President Donald Trump has urged Iran to get serious about negotiations or face consequences. Officials in Iran say they have no intention of having talks with the U.S. The Bank of Canada says higher oil prices will push inflation higher in the near term. The senior deputy governor, Carolyn Rogers, says the central bank's priority is to ensure the higher prices from the war in Iran does not lead to ongoing and persistent inflation. Rogers says it's too early to assess the impacts of the conflict on Canada's growth, but added the country is dealing with forces that will put the economy on a different path. Shares of BRP getting a boost today after the maker of skidoos and recreational vehicles reported revenue and profit in its latest quarter that beat expectations. Revenue jumped 17% compared to the year before. BRP also boosted its dividend and delivered a 2027 revenue outlook that came in above estimates. Bank of Montreal is betting on its U.S. segment to accelerate growth and lift returns. Speaking at the bank's investor day, the CEO, Darryl White, said the company's counting on a rebound in its U.S. business to boost overall results, as well as growth in its wealth management segment. The U.S. division accounts for more than 40% of BMO's earnings, but has underperformed in recent years. The lender is also targeting a return on equity of more than 15% by 2028. Here is where we stand on the markets right now. The TSX Composite down 1.4 today. That's a drop of more than 400 points so far. Let's go south of the border. The S&P down 1.7%, so over 100 points down. The Dow 1.1% down. That's a drop of 500 points plus. And the Nasdaq down 2.25 or 492 points today. Investors' fears continue to rise with no clear end to the war in Iran. But our next guest says history shows geopolitical shocks rarely knock equity markets off course for long. Brian Belsky joins us now, CEO and CIO of Cumulus Investment Strategies. Thanks for joining us today.
Thanks for having us, Morella. Good afternoon, Canada.
So there are comparisons to what happened in the 1970s and the oil crisis then, but you say things are different now. Can you explain?
Yeah, anytime you say it's different this time, that's usually the kiss of death, quote unquote. But the variables with respect to fundamentals are very, very different with respect to energy. Let's kind of take two steps back, and here's the reality. The United States of America is the world's largest producer of oil. And it wasn't that way in the 1970s, in the embargo actually had that forced double dip recession in the 1970s. We were much more reliant on what was happening in the Middle East. And then, of course, we had the Iran terrorist activity in 1979 into 1980 that really drove the United States into that almost second dip recession. And so we're in a much different base of support here. That's number one. Number two, I don't know if it's a war yet. I think that's a little bit too aggressive. I think there's an issue there that had to be taken care of with respect to not only national security, but also the security of the rest of the world. And I do think that at the end of the day, what we're seeing there is going to happen and going to unfold probably a lot faster than everybody thinks. You know, it's really interesting, Morella, about politics is that in geopolitical events, it's really difficult to invest around them. I remember my very first year being paid to do this job was 1990. And my boss at the time was William O'Neill. And in August of 1990, he brought the entire company together on one floor. And he said, I think we're heading into a recession. That's when Iraq invaded Kuwait. Market was down 8% for the first 3 months. And then a year later, the stock market was up 10.2%. And so I think it's really difficult to time these things. We do believe that this is not a full-blown war. We think this is a situation that we believe will be over a lot faster than everybody else thinks.
Okay, so let's talk a little bit about where do you think the price of oil, which has been hovering, depending on where you're looking, in the mid-90s or over, where do you think it'll land after the conflict?
Well, you think we start to see demand destruction, quite frankly, above $100 for a duration. Duration means a period of time. So we think it's 3 to 6 months minimum to be above $100 to see the type of demand destruction that most people are worried about in terms of recession. We think, given the fact of supply is very strong, the strategic petroleum reserve is being rebuilt. We have the issue with respect to U.S. energy in general, and the strait is open. And so at the end of the day, we think that we're going to hover back down in the 60 to 70 region, at least to start. And remember, too, that supply in terms of oil has been increasing for the last couple of years. So we think this is a shock, and investors should not be reacting to it accordingly.
Okay, so many experts that we have spoken to here say it is the fallout that could be the big deal, because some of the production is now offline in the Middle East, plus you've got the backup in the Strait, plus energy reserves are already being tapped. Are you factoring that into your projections?
100%. Of course we have to. And remember, it's been a month. And again, too, a month doesn't shut things down. They can crank that right back up again. And if you think about the supply that can come out of there much more freely once ships are feeling safe about providing oil in and out of the Strait, I think that's going to be really important. Plus, remember, too, you got the pipeline coming out of there as well. So I do think that people, once again, are focusing on the negative. Canada tends to be a much more macro-dominated, especially the energy side of things, and default to the economic point of view. I think from a fundamental perspective, there's a reason, Morella, there's a reason that U.S. stocks have dramatically outperformed the rest of the world during this conflict. And it's because from a fundamental perspective, we're much better positioned longer term. If there is a prolonged 3 to 6 month time frame, which is not our base case, but if there is, that's why U.S. stocks have actually outperformed during this entire time.
Okay, let's get to some of your stock picks during this time. Costco is one. I've heard others raise concerns about valuation. Does that bother you?
Others, I know others are negative. Costco is the top 25 company in the world. Costco should be part of every North American portfolio in terms of large cap and core. Here's why. It fits a fantastic theme in terms of consumer staples. Their business model is amazing. They make so much money off their memberships. Plus, we're all sitting in line with our cars trying to buy cheaper gas relative to what's at the gas station. And so that trend continues. And plus, with respect to what they're doing in food and just overall merchandising, we think Costco is a top 25 company in the world. Okay, let's get to your next pick. Shopify. What are you liking about Shopify right now? Shopify, I think, has been unjustly kind of baby in the bathwater in terms of some of the technology stocks, Morella. We think that Shopify is the portal for small mid-cap companies in North America. And we do believe that if and when we see a broader unwind in private credit, private equity, those assets are going into small mid-cap companies. And that should only further solidify the business model and the business volumes that we're seeing that coming into Shopify. So Shopify, we believe, is a top 10 tech holding in North America. Interesting. Okay, I do have to leave it there, Brian. Unfortunately, I'm out of time, but thanks for your time. Appreciate it. Thank you. Coming up, BRP, Canadian manufacturer of snowmobile skidoos, posted their latest quarterly results. We'll hear from the CEO when we come back. We're watching shares of BRP today after the company reported their fourth quarter earnings. Solid demand for off-road vehicles and personal watercraft lifted results, helping mark a rebound after the stock slipped earlier in the year. For more, we sat down with Denis Leveau, CEO of BRP.
We're posting a growth for fiscal 26. We also announced a guidance of a growth for fiscal 27. So the momentum is very strong here.
What went right for you? A 16% jump in the fourth quarter, earnings beat for the expectations. What did you like about this quarter that stands out for you?
Well, this quarter actually showed that, the DNA of BRP is to offer power sport product, a lot of innovation to the client. This is what we did, and it pays off. Because in the Q4, we've been increasing in North America, especially in off-road vehicle, by 12% our retail volume. And this is totally outstanding. And this is mostly, by the way, on the SSV market with our new product, Defender HD11, totally new platform, and it worked very well.
And what is that? The SSD, is it?
Yeah, these are side-by-side vehicles.
Okay.
And this is really the biggest market we're having here in Canada. as well as in the US. These were the two biggest quarter ever that we had in the Q2 and Q3 and Q4, sorry, in Canada. And in the US, we continue growing.
And where do you see, I mean, you're optimistic on what is coming up. I think you're seeing growth of about, you're predicting growth of about 7% in sales. I think 7-8%, I did quick math. Where do you see that coming from, and how do you meet that?
These are twofold. The upcoming growth in 27 will be coming again from the off-road vehicle. This is a very booming market, both on the recreational part, but also on the utility part that we are joining, professional, using our vehicle, and this is very big. So there will be a piece of even carryover of what we did in the Q4, and we're going to continue profiting by this boom that we're having. Also, on the other hand, our bread and butter historical, as you know, are the ski-doos and the sea-doos, and well, the winter continuing helps us on the ski-doo, and we have a very big portfolio of order by our dealer on both of these also.
I'm wishing, for the record, I'm wishing winter would go away. You mentioned the professional market. What is that, and what kind of potential do you see there?
Well, there is a potential, actually. This is the biggest growing segment in North America on the side-by-side vehicle. These are professional, usually, example, farmers that would use our vehicle. Now we're putting cabins on them, even HVAC, so it's very comfortable to use. And we are really doing tough and very capable products, and then hence the success that we're having. So this is where we are growing the most in North America.
And with, I mean, you faced some headwinds. With the tariffs have been around, costs have gone up. How did you manage those two things over the last little while, and how do you see that moving forward?
Well, as you can see, we post a very profitable result, right, despite the tariffs. Tariffs are more or less an impact of 90 million. We can live with that so far. And then, of course, let's see how it develops in the future. But we have been proving to be agile, and we'll continue to be.
And how are you? What are you expecting for the tariffs moving forward? Are you factoring them in at that same rate, higher rates, or that they might go away with a new deal?
No, as per the tariff, we just cooked in the exact same rate as we had in the past.
Okay, and looking back, you had the EV impairment. That's now off. Has that changed how you move forward? Do you see a potential for EV still?
No, not really. It doesn't change much, because in the sense that when we did the investment, of course, we were foreseeing a quicker EV pickup of the market, as everyone did in all the industries, including automotive industry. Not the case, so we have to make this write-off, but it doesn't mean that we get away from this business. We see a future for that. We have excellent electric motorbikes that we will continue pushing on the market, and also we have some success with the electric ATV, especially, which are demanded all around the planet, by the way.
And with everything that's unfolding in the Middle East, does that change your thoughts on your guidance? What's next? Any concerns about fuel, things like that?
I would say short term, not really, because we took some precaution in the guidance. The guidance is going from $5 EPS to $6.5 EPS. And number one, the markets down there are not that big for us. We are big in North America, in Latin America, and Southeast Asia, but the markets down there are not that big. As per the first half of this year, we are hedged and covered in most of our purchase of raw materials, and we cooked in our guidance $100 a barrel, see what happens, in our direct costs. I said before, but we have a strong momentum, so in terms of orders, the Q1 and the Q2 of this year are almost done. So what we did is that we took a precaution, but that would come more from the potential global economy of a more difficult second half of the year, if it happens, and a 5% decrease in the volume is what we cooked in the low range of our guidance. So from that standpoint, I think we've been cautious on what we are giving, and hopefully we are working to deliver the upper range of the guidance.
And just from a personal, it's been, what, now 2 months since you came over? What are you finding the difference between being in the auto industry and being in the recreational vehicle or recreational sector?
Two things at the same time. There are things that are the same. We are a volume industry making hundreds of thousands of vehicles, working B2B to C through dealerships. And then you find the same challenges as you find in the auto industry. The size of the brand, the power of the brand, working with the dealers, the way you can control your economics, your quality, working, we talked about, in the regulation environment, etc. This is all the same. Now, the products are very different, and this is what attracted me here. I'm a fanatic of riding motorcycles, and let me tell you that the products that BRP is producing, would it be on the snow, on the water, or on the ground, are fantastic dream machines, and that is a big difference.
Denis Lavos, CEO of BRP. Pizza Pizza reported earnings. We'll hear from their CEO when we come back. Pizza Pizza shares are climbing after the company reported its fourth quarter and annual results. Despite geopolitical uncertainty and some cautious consumers, let's find out how they did. Paul Goddard, president and CEO of Pizza Pizza, joined us.
There's no doubt it is one of the most competitive out there, and it has been for a long time. And I think it's just exacerbated in the current environment. But we've been around a long time, coming up to 60 years, so we been through a number of cycles, and we feel like we can weather this kind of thing.
And so what led to this quarter and the year, the success of that?
Well, I think it was, a positive same-store sale. It wasn't our banner year, but we're certainly happy to be
But
positive.
I think most people right now in your industry would be happy with...
Some are negative, some are positive, but I would say generally most people are not doing so hot. So we do expect actually better for ourselves, but we are positive on the year, so we'll take that. And, our traffic overall in the year was up. That's how we really measure success. It's just the volume of transactions really shows people are still ordering from us and growing. So, we'd still like to see bigger numbers, obviously, but it is a tough macro environment. And so I think overall we've been innovating, focusing on value, which we're really known for, sort of quality and value. And so we're going to lean into that even further and just continue innovating on our tech platforms, our on-time delivery, things like that, things we can control. We're going to have those levers to pull and reinvest, but then also be very cost conscious as well in this environment fiscally, just because the macro environment is so challenging.
All right, and I'm not saying this in any kind of a context. When it comes to pizza, how do you innovate? What do you do with it?
Well, you can innovate not only on the food. I mean, things like for us, an example would be crusts. I mean, we have been very successful with a gluten-free crust, I should say, cauliflower crust. We're innovating some new crust this year and other, healthy ones. And there's also a line called Gourmet Thins we have, which are much thinner. So actually, you can really engineer the product, even though it's dough, sauce, and cheese, basically, with toppings. I mean, it's pretty simple, obviously. But you can actually innovate. You can make it healthier, smaller, bigger. We've also gone the other way and had bigger pizzas like the Double XL with Vladdy Jr. coming to us and saying, can I do a special with you guys, which was really nice. He approached us. Yeah. And that was great timing with the Blue Jays last year. So I guess we're pretty nimble on that side. We're always innovating on the menu, but also behind the scenes, too, in terms of the IT infrastructure we have. It's a really scalable cloud-based structure. We invest all the time, I think more than most of our competitors or peer group. In terms of percent of IT spend versus sales. And so that really puts us in good stead with our apps and our digital refresh that we're doing as well. So it allows us to provide better loyalty, innovation. The restaurant itself gets innovated. We can automate more things. So some of it's not the sexy parts, but it's really important to be efficient. And then the food itself, that we want customers to think it's great, tasty food and get them coming back again.
Okay, and I've got a bunch of questions from all that. First up, innovating with technology, the oven costs that were last time you were here, there were concerns about that. Yeah. How are you dealing with that?
Yeah, we still see increased costs really there. I mean, obviously there's now renewed tariff uncertainty with, are they legal or what have you, given the ruling in the United States. But we still see suppliers very nervous, as you might expect, and looking for increases. Generally, on our food side, we have a Canadian supplied food basket almost exclusively. So we don't really have too much exposure there, really at all. But in terms of food equipment, we do. So it does impact things like construction costs. So we need to be really careful about our overall construction budget because the franchisee at the end of the day is paying for that restaurant. So we have a budget that we want to deliver to them that gives them a good return on their investment. So it is hard. We can control things, cut some costs in some areas, but there's some costs we can't control. And we'll see what happens with USMCA and other things as well. So we're positioned quite defensively right now and just being a little more selective even than we already were with how we pick sites and does the economic model make sense for a new franchisee coming in.
And you mentioned the Canadian foods, your food basket is Canadian. That must be a challenge with the expenses that are coming with. How are you coping with that?
Well, it is. I mean, we've held the line quite well. It's been better generally, for a couple of years. It was quite awful, pre-COVID, COVID. There's a whole inflationary effect. It's been okay, but now with the macro geopolitical issues, obviously with this sort of oil shock that seems to be going on, and we don't know how long it's going to go on for. No one really does, affecting every company, every country, really. So I do think my personal view would be that inflation is going to pose a risk for a while, and that will have a trickle-down effect to fuel and non-discretionary spend of consumers. So that could really exacerbate issues, which haven't actually been that bad generally the last couple of years, maybe 3 years, 2 years ago. But now I do think it is getting a little worse. Headwinds are getting stronger.
One of the challenges you mentioned, fuel for your staff, for drivers. How are they being compensated with everything, with prices that are going up, or do you use outside sources?
For our drivers, I mean, they are they're independent contractors. They work for the restaurants, so they're actually working for them. So they, what they really rely on actually is tips. And so it really comes back to great service. So come back to our on-time, our free guarantee. We have a great track record there and a lot of metrics. So we have things, an example of innovation, how it helps the driver is if we now, which we do provide visual order tracking, just like on a third-party delivery platform, you can see where your order is on the map getting to your home. If it gets there in, say, 32 minutes, which is a typical average order, it's under 40 minutes, it's going to be, you're paying for it. But if you get there at 41 minutes, it's free. And so our drivers know that, and they deliver very consistently there. And if they provide it with a great experience, they've got a uniform on, they're providing it hot and fresh at the doorstep, then they're going to get a good tip. And people actually pre-tip as well because they're used to us. And
so is the company helping out at all?
We're not helping the contractors. We basically try and help them by driving sales. That's really all we can do. We're not in the business of subsidizing individual drivers, but what our job is to make customers order more frequently and hopefully a bigger basket, given our specials, make them compelling, so that overall the sales are good, and they get essentially a percentage of that through their tips, really, and they really rely on that because that's their lifeblood.
Okay, and with your customers, GLP-1s is everything. Everybody's talking about weight loss. What kind of an impact is having because pizza's not always perceived as being the healthiest of foods.
Right, it's certainly not perceived as it, and that's a whole other discussion. But it is actually, at least a pizza is a baked item. It's you can make it extremely healthy with all the 4 food groups. You can have it thin crust, easy on the cheese, grilled chicken, hot peppers, and avoid any very heavily caloric items, right? But there certainly is the sort of joy factor for a lot of people that want a deep dish pizza, and that's fine too, right? We sell a lot of those. But I think that's a trend for sure. We'll see how long it stays, but people are more health conscious. We haven't really seen that particularly be a negative, I would say, at this point. But what we do to sort of preempt that is offer a big array of healthier items. We have some baked items. We've got a lot of gluten-free, plant-based items. Thinner crust items, cauliflower with 2 servings of cauliflower in one of our crusts. So if you can provide a lot of healthy choices, then people can choose for themselves. So we think even if the people migrated that way, we'd be fine because we're sort of economically neutral on that as long as we still get transactions for the healthier pizzas.
Paul Goddard, President and CEO of Pizza Pizza. Coming up next, the closing bells on Bay Street and Wall Street. A last look at the markets. Ahead of that, we are in the red today. The TSX Composite down 1.5%. The S&P down 1.7%. And the NASDAQ down 2.3%. We're back in a moment. Stay tuned. Here are the closing bells for the end of the trading day. At the NASDAQ, Merrick's Group ringing the bell. In New York, Global X ringing the bell. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The conflict in Iran still weighing on North American market. The TSX dropping 1.5% today, 495 points down to end the day. The S&P down 1.7% or 114 points, and the NASDAQ down over 2% today, 2.4%. That's a 521-point drop on the day. Quick look at oil. This is West Texas. Look ahead to the May contract. It is actually up 4.3% to $3.90, a move to 94.22. Let's get to the movers in Toronto. So gold and silver stocks, pretty hard hit today. Equinox Gold down 7%, Endeavour Silver down 6.8%, and then K92 Mining also down 8%. Celestica also losing steam today. That stock down by 9.4% or a drop of $39, taking the share price to $378.58. And Cogeco Communications dropping today 8.3% after being downgraded today by TD Cowen. We'll have more on that in a moment. So that was a loss of $6.37 per share. Let's cross the border. The U.S., the rental car companies doing well. So Hertz and Avis Hertz up 8%, Avis up 13%. As the airport disruptions continue, you've probably seen the long lineups at airports across that country. So some people choosing, I guess, to rent cars instead of fly. Now in healthcare, shares of Wave Life Sciences plunging. It dropped down close to 50% after an obesity drug failed to meet expectations in early trials. Let's go to Bloomberg's equities reporter, Stephanie Hughes. She joins us now with more on the movers. We didn't mention BRP in the movers today, but the Quebec company makes skidoos and they reported earnings. Let's start there.
Yeah, that's right, Marella. So it was pretty much the top performer earlier in the trading session on the TSX, but it was trading places with a few other names. So those shares gained by over 7% at their highest point today, which marked its biggest advance since December and helped recover most of the losses sustained throughout the month, or about a month's worth of losses. And that's because the recreational vehicle company that makes ski-doos, sea-doos, and a bunch of other fun toys that my sister and I used to putt around on in cottage country up in the Timmins area. So that company, their fourth quarter results, revenues and earnings came ahead of what analysts were expecting. So on top of that, the Quebec-based firm's 2027 full-year revenue guide, ranging between $8.9 and $9.2 billion, was also a beat. And in fact, even the lower end of that range beat what the average analyst was expecting. So some analysts weighed in on this. We had TD Cowen's Brian Morrison saying that this release was slightly positive, noting that there was a solid balance sheet and a healthy industry inventory position, and even pointed to it described an innovative new product lineup. Some viewers may recall that BRP was releasing some of the electric recreational vehicles over the past few years, and those might be starting to gain some traction now. But taking a step back, the stock had been under pressure since the beginning of the month, but starting to recover some of those losses. In fact, it's on a 4-day winning streak today, or as of today, Marella, and today's earnings are kind of helping propel that onward and upward.
Okay, we'll keep an eye. Let's go to Cogeco Communications. Shares are down. If you could expand on what happened there.
Yeah, that's right. It was a different story for Cogeco Communications. That stock was hit to the tune of a negative 9% drop at its lowest point, its biggest drop since last July. And that's because, as you alluded to at the top of the movers hit, it was hit with a downgrade at TD Cowen after analyst Vince Valentini moved his recommendation to a hold from a buy rating. He also downgraded the parent company Cogeco. So Valentini said Cogeco Communications had a nice run recently, up until today, obviously, but there were reasons to be kind of cautious in the near term. He added that the sentiment and headline risk can hit Cogeco with volatility, and his team just would rather just wait for a lower entry point before they buy in, or just kind of wait on the sidelines and not recommend that anybody kind of jump in at this point. And that was their team's argument. So Valentini, I would say, does raise a good point about the recent run-up. Before today's drop, shares of Cogeco Communications had been up by about 15% year to date. That was even outperforming some other cable television providers like BCE and Rogers, of course, before today's drop. So this is taking a bit of steam out of a company, or out of a stock that had been flying high, Marella.
Okay, we'll leave it there. Stephanie Hughes, thanks for the update. Coming up next, markets, as you saw, close lower, pressured by rising oil prices after the U.S. president warned Iran that they need to get serious about negotiating. Back in a moment. Micron shares are under pressure for a second day after Google unveiled technology that could lower the amount of memory needed in AI models. We were joined on this by Matt Bryson, analyst at Wedbush.
That Google improving the algorithms around using memory is legitimate. I don't think it changes how much memory gets used, though. So the things I point out are, one, if you're buying an AI chip, so say a B200 or a B300 product from NVIDIA, it comes with a set amount of HBM. So regardless of whether the memory is bottleneck or not, you're still getting, for the B200, 192 gigs of HBM. And so the number of chips is going to define how much memory you buy, not how efficiently you're using it. And then from a longer term perspective, so we'd have to be thinking out a couple of generations. The idea being that maybe if memory is being used more optimally, that NVIDIA isn't designing as much memory alongside chips. The history of memory is that everything becomes more memory intensive. And so we're always seeing optimizations. I don't think if we move out 3-4 years that you're going to see memory content per chip go down. And so from my perspective, in the near term, it just doesn't matter. And in the longer term, it probably doesn't matter.
All right. Just quick, I'm going to ask for the people who may not know what it is, myself might be included in this. HBM is something memory, right?
Yeah, it's high bandwidth memory. It's the memory that gets attached to NVIDIA chips or TPUs. So it's the memory being used predominantly for AI.
Okay, and so where does Google fit in then with what they're doing? Where do you see that finding a place?
As workloads shift towards inference, memory has become more and more of a bottleneck. And so over time, this potentially allows your whole AI board, if you will, to be more efficient. And so it's a good thing, right? One of the questions about AI is how expensive it is. If you're able to make it less expensive, get more performance per chip, it should hypothetically increase adoption over time because it's more efficient to use AI.
All right, and we're seeing the sell-off. I mean, looking at Micron is down after they had a great earnings report last week. Do you see people taking a second look at this and going, no, we need to relax?
No, I think it's just that everyone is always nervous when you have these cycles in silicon. So I don't think we're anywhere near the top of the memory cycle in the sense that I don't see this year or even next likely how you find a path to having enough DRAM or NAND supply. Having said that, we're at all-time historic highs in terms of margins, in terms of cash generation, and so I think during these periods, people are a bit quicker to choose to sell, just because. Again, there's a long way down during a down cycle, and so when you get news flow, it makes people nervous.
Is there a new direction these companies are looking for when it comes to memory, or is it just trying to cram more into the same space?
I mean, I think everyone's always trying to optimize. There have been, hypotheticals around new types of memory, but what we've seen for the history of memory is you had NAND come out and gain traction in the 2000s. Beyond that, there have been a bunch of different types of memory that have been introduced and just haven't gotten traction. So Intel's Optane is probably the best known, but you had things like ReRAM and the crossbar memory, and it's just really, really hard. And so I think people will try to use memory more optimally as it exists, but I think finding new types of memory, it's going to be a long process with uncertain success. Now,
Intel saying they hope to have this out later this year. Is that timeline realistic with everything that's unfolding?
It's not unrealistic that something comes out. I think it's unrealistic if you think there's going to be significant adoption in a relatively short time period. So what Intel showed with Optane is not necessarily that Optane was a terrible product. It certainly didn't quite live up to the hype that Intel had when it was first introduced. I want to say in like 2017, 2018. But the larger problem was shifting around all the infrastructure and software protocols to work with that memory, because the processor has to understand it's dealing with a different type of device. The software that you're running has to understand that the parameters of this memory are different. And so doing all that work is really hard and time consuming. And so I'm not necessarily saying that Intel won't hit their timelines, but adoption is something that will take years, just because this is really complex. And
then can we throw AI in all of this? And where do you see AI fitting in over the next year with speeding things up, improving memory? Is it at that point it's going to be used even more so?
I mean, I think that's what we're seeing, right? You're seeing agents kind of take over the conversation. So you had NVIDIA showing off OpenCloud GTC last week. There have been a ton of stories about how OpenCloud's getting substantial traction in China in particular. So that's agentic AI in the device. But I think from an inference perspective, for organizations, I mean, we're using it more and more in my workflow. You're certainly seeing it on the coding and software development side, that AI is becoming a bigger and bigger portion of the workflow there. And so I think that as you can get AI more efficient, it just continues to gain traction. And the last thing I'd point out is we've had 3 of the 4 largest tech companies in the U.S. come out and tell us that they're only spending more on AI. And so certainly they're seeing something of an inflection.
Matt Bryson, analyst at Wedbush. Coming up next, markets lower today, pressured again by rising oil prices and an unknown end to the conflict in Iran. We're back in a moment. North American markets are deep into the red today, with continued confusion on when the conflict in Iran will actually end and when oil shipments will really start to move again. Let's go to Scott Wren, Senior Global Market Strategist at Wells Fargo Investment Institute. Thanks for joining us today.
Hi, Marilla.
What has the U.S. bond reaction been like to the higher price of oil and then lower stocks?
Well, I just think that, this is all based on the flow of oil through the Strait of Hormuz. I mean, if that was not going on, the world would be well supplied with oil. So that's, and there's a lot of guesswork involved here. And, we're optimistic on the economy. We're optimistic on the market. And, Marilla, you could do all the statistical analysis you want, all the modeling you want and all that. But when it comes down to these types of events, you've got to make some educated assumptions. And so that's what we're trying to do. We don't think this is going to last all that long. We've been using the term short. So we think we're going to be back on track not too far from now.
Okay, so you don't think the conflict itself will last too long. Do you have concerns about the price of oil staying higher and staying higher for longer? At what price point would you have those concerns?
I think, above 90 is a problem. We don't think it's going to be there. Before this conflict, we thought oil would end this year at $60 or $70. Now, could we be off by $10 or something like that? I think probably we could. So if our midpoint 65, maybe reality by the end of the year might be closer to 75. But I think for us, the price at the end of the year is going to be meaningfully below where it is now on both Brent and WTI.
Okay, so you see positive factors for the market that you think investors should remain focused on. The first one is AI. How are you playing into AI at this point?
All last year, most of last year, we were overweight the tech sector. We were overweight communication services. But then, we felt like those stocks were stretched and fully valued. I think in the summer, late summer, we cut out of communication services. Then in October or November, we cut out of technology. And what I mean is we went from an overweight allocation to an even weight allocation. And we still want to play that theme. And remember, those 2 sectors alone make up about 45% of the total market cap of the S&P 500. So even at even weight, you've got a pretty full load in terms of technology. And so we thought we'd try to take a little different angle. Somebody has to build the data centers. Somebody has to provide the components. Somebody's going to be updating the electrical grid. And those companies are all in the industrial sector. So we like the industrial sector. We like utilities. Clearly, our utility analysts think at a minimum over the next 7 to 10 years, we see a 25% increase in energy demand in the U.S. I've seen some analysts out on the street think it's going to be 50%. So utilities are going to benefit there. So right now, in terms of overweight weightings, industrials and utilities are the way we're playing it.
Okay. Where are you on small caps these days?
Yeah, small caps, I tell you, for the first time last time, as you and your viewers know, small caps outperformed. We think that was more of an aberration, more of a trade. I think that you really have to have probably a more of a contraction in earnings and more of a contraction in the economy before you see that upswing where people are really more willing to take on risk. Now, in a higher growth environment, and, we thought the economy would grow. Our official number out there is 2.9% right now, which is clearly a really good number for a $27 trillion economy. Now, could it be a little bit lower than that given what's going on with oil? It probably could be. But I think for us right now, we've had that quality theme, and that means large cap. We like mid caps as well. But, we want good balance sheets, good cash flows, lots of products, own your niche. For us, just a sustainable small cap outperformance where you'd see it happen for a 2 or 3 year period. I don't think it's there yet. That may change once we get through this. We'll take a look. But right now, and even really before this Iran war, we were not fond of small caps.
Let's talk about fixed income. Are you in fixed income right now? What are you doing with that?
Well, I tell you, we're underweight the short end of the curve. We're underweight the back end of the curve because we just felt like the yield on the 10-year probably going to end the year. Our target range is 4.25 to 4.75. So, we're moving toward the middle of that right now. Short term, we had really felt like the Federal Reserve had a cut or two in them. Clearly, the markets price that out right now. So we've stuck to the middle of the curve. The intermediate maturities, 3 to 7 years, investment grade corporates. We like munis, essential service munis. So, our focus on the bond market is pretty narrow, and we've certainly been leaning towards stocks and away from bonds. And to be honest with you, we're looking for another opportunity, which, this has been a reasonable sell-off. I think it's only about 7.5% so far. But, I could see us taking another step toward stocks and away from bonds, if the market trades a little lower here.
Yeah, at only 7.5%, it feels like much more when we've been going through it.
I mean, really, if you think about it, in the long history of the S&P 500, there's a 10% pullback on average about every 10.5 months. So they happen. We're not there yet. But certainly with the sentiment out there right now, you couldn't say, and the way the market closed today, you can't say we're at the bottom.
Okay. Let's leave it there. Scott Wren, Senior Global Market Strategist, Wells Fargo Investment Institute. Thanks for that. So up next, thank you, sir. In a landmark trial in the U.S., Meta and YouTube have been found liable. So we are taking that case and looking at cases in Canada that deal with similar problems. We're going to talk about that in a moment. Some new information on the Iranian conflict, courtesy of Donald Trump on social media. He says he's extending the pause of strikes on Iran's energy sites until April 6th at 8 p.m. Eastern time. So here's what it actually said. As per Iranian government requests, please let this statement serve to represent that I am pausing the period of energy plant destruction by 10 days, again to Monday, April 6th this year at 8 p.m. Eastern time. Talks are ongoing, and despite erroneous statements to the contrary by the fake news media and others, they are going well. There have been questions about who Washington's actually talking to. Iran has denied that talks are ongoing or that they're wanting to negotiate. But according to the American president, they are talking. This was a request from Iran, and they're going to not hit the energy infrastructure in that country until April 6th. So it is being called the big tobacco moment for social media companies. A U.S. jury finding Meta and Alphabet negligent, saying the companies knew their products were addictive and harmful. It may be just the beginning. Let's go to our Bloomberg's Kurt Wagner on this. He's got some more insight into what has been happening with the case. Kurt, can you first explain the big tobacco comparison?
Sure. Well, this is really at its heart an addiction case. And what the jury decided in Los Angeles this week is that these companies were, creating products that were addictive, and they weren't properly warning users that you could become addicted if you're using them. And so obviously that draws some comparison to other consumer harm cases, tobacco, I think, being probably the most notable, opioid cases as well. And so it sort of feels like, is this the moment where these networks are being deemed to intentionally cause harm of people and not prepping them that they can cause harm? That's sort of why you're getting that comparison.
Okay, we do have to remind people that even though this was the outcome in court yesterday, and we know Meta will fight the outcome, is Alphabet going to fight it as well?
Yeah, both companies have said that they plan to appeal this case. I should point out also that this is really the first of thousands of similar lawsuits that are awaiting trial. We're going to get to some more of those later this year, not just from, sort of regular users, sort of personal injury plaintiffs, but also from school districts and from states' attorneys general. So there is a huge sort of lineup of people trying to go after the companies right now over this exact issue. And this was just case number one. Okay,
so let's talk about some of the arguments in court, because I know Meta had argued that they didn't have the technology then to make sure, for example, younger users were on its site, and that things have changed more recently. Did those kinds of arguments make a difference in this case?
I mean, clearly they didn't resonate with the jury because, the jury voted 10-2 to essentially convict Meta of these allegations. And, one of the things that they also spent a lot of time arguing in court was that this young woman who sued them, her mental health problems, Meta argued, were caused by things outside of the technology, right? It was caused by her home life, her parents, her family. And again, that certainly didn't resonate enough to sway the jury here. And so as they move forward to these other cases, they're going to have to come up with a different argument because it doesn't seem as though the jury found that very convincing.
Okay, what could change for users for social media in the interim period? Could anything change?
In the interim, not much is going to change. There's no stipulation from this particular trial that they have to make any product changes. Now, there are people suing them who want to force product changes down the line. And it's possible that Meta, YouTube, and others will make product changes on their own to avoid, facing more lawsuits down the line. The things that people want to see changed are, things like infinite scroll, this idea that you just continually scroll on the phone sort of forever, an unlimited amount of content. Notifications, or there should be set times for when notifications can go off, so it's not happening during school hours or in the middle of the night, especially if you're a young person. And so there are a long list of features that sort of critics of these tech companies want them to change, some that the companies may choose to do voluntarily to avoid more lawsuits, and then some that perhaps a court in the future will try to force them to change.
All right. Bloomberg's Kurt Wagner joining us with the latest out of that monumental case. Thanks for the update. Appreciate it. So the social media addiction trial was watched by many around the world who blame social media creators for addicting children to their platforms and for the fallout from that. One of those watching closely, Sonia Niger, she's partner at Neinstein and joins us now to talk some more about this. Thank you for your time, Sonia. You're one of the lawyers on a similar case in Ontario, but it's school boards suing the platforms. Can you tell me about the crux of the argument being made?
Thanks for having me. Yeah, absolutely. So we represent a number of school boards across Ontario who have alleged very similar claims as to what we've seen unfold in the U.S. The main issue here is that we allege the companies have designed these products in a way that has caused, whether it's addiction or compulsive use, that has widespread effects on the student population and resultingly effects on the ability to deliver education. There's been educational disruption, significant educational disruption that is affecting the school board's ability to execute what it needs to do in order to prepare, our next generation of leaders.
Sorry to interrupt you. What was your reaction to the results in the case yesterday? And does that at all bolster a case, even though it's across the board?
Yeah, I mean, certainly the result was very encouraging. I think it's important to note that there were actually 2 verdicts that came in over the last 48 hours that are resoundingly clear that these companies need to be held accountable for not only what they've done, but what they knew at the time and the harm that they knew was befalling really a very widespread population, not just youth, but certainly, of course, most importantly, children. Of course, we are litigating here in Canada. It's a completely different framework, different set of legal thresholds, but it is encouraging, and we are following very closely what's happening in the States.
Okay, what are the companies named in your statement of claim? We know what was happening in the U.S. are the same companies that were brought up, what they're initially named in the U.S. case, named in the Canadian case?
Yeah, so we've named Meta, their subsidiary companies. So the platforms are Instagram and Facebook, principally on those with that company, Snapchat and their subsidiaries, and ByteDance, which is TikTok.
Okay. Let's talk about the fact that some of these companies we know have argued in the U.S. that they didn't have what was necessary to put curbs on their platforms historically, and that was part of the problem, but that things have changed and there are more controls or parameters now in place. How do you argue something like that? Would it matter in a case like the one in Canada?
Yeah, I think it does matter. I think the short answer is that it does matter. We intend to, and we have alleged in our statement of claim that that assertion that they didn't know is in fact not true, and that their ability to make at least some of the changes that we say ought to have occurred a long time ago was there. It was present, and that's part of what will be established on an evidentiary foundation at trial using experts and related disclosure. But certainly this is a dynamic and complicated problem. Nobody's pretending that it's not, but there is a foundation on which to argue that these companies knew exactly what they were doing. There were other options that would, put safety over profit, and those decisions simply weren't made.
So, Sonia, because your case is wider, right? The case in the U.S. that we've been talking about centered on one woman and the damage done to her, specifically injuring her mental health as part of being addicted. Because your case is broader and is brought about by the actual Board of Education or the Board of Education in Ontario for Toronto, how do you prove that damage was done in a more widespread way? Do you have to prove that as part of your case?
Yeah, certainly. I'll just maybe clarify a couple of things. So one is that there is a class action here in Canada, which is similar to what that individual case that was brought, that we saw a jury return a verdict for yesterday. And so that litigation does certainly also exist. There are also thousands of school districts in the United States that are claiming very similar things to what our clients are claiming. And those trials will likely take place sometime this year, certainly before our trial is commenced. With respect to proof, certainly what we're alleging is where one individual, as we saw in the return verdict yesterday, has been harmed by this addictive design. Where there's one, there are thousands and thousands. And the mass effect of those disturbances, to mental health, also to physical health, have had an impact on the operations of the school boards. And so there will be, as there was in the cases that we're talking about here today in the United States, expert evidence from psychologists, psychiatrists, a variety of professionals to suggest that same phenomena has occurred en masse, and that there has been an impact, again, on the operations of the schools. Something I like to say about what we've seen unfold over the last 2 days is that common sense has prevailed here. Regular people, jury members have looked at the evidence, have decided that what we've all seen unfold over the last, I'll call it 15 years, probably more, implicitly and explicitly to our children, to ourselves, by the use of these products is now being finally recognized. And the fact that the law has a response to that shouldn't really be much of a surprise. That's what the law should do.
Yep. Sometimes the law doesn't always do what we think it should do. So I understand what you mean. Sonia Najera, thanks for joining us. Appreciate your time.
Thank you very much.
Air Canada back under fire again. The CEO's response to that deadly accident is sparking backlash. We'll talk about it when we come back. Air Canada and its CEO are facing another crisis. It's not the first time the national airline, of course, has found itself in the headlines for the wrong reasons. This time, it's about a statement that the CEO delivered after that New York accident that killed 2 of its pilots. The message was delivered only in English. Let's go to PR expert Jamie Watt, chairman, founder of Navigator. He joins us now to talk some more about this. Jamie, thanks for your time.
Hey, thanks for having me.
So the CEO's inability to speak French has been on that company's radar for a number of years. Shouldn't it have been at the top of mind at the time?
Of course it should be. And I think that's why you're seeing the kind of reaction that is taking place. Air Canada has 2 problems here. The first problem is that they have a legal obligation to provide services, all services, in both official languages of Canada, English and French. It's not something they've got an option to provide. They must provide. Other companies are not under the same legal obligation. They can choose to do it for commercial reasons or for other reasons, but not Air Canada. They have to. That's point 1. And point 2, this is the first time the CEO has been in trouble for his inability to speak French. And the last time it happened when he gave essentially a unilingual speech to the Montreal Chamber of Commerce, he promised that he would learn French. And since that time, a number of years have passed, and he hasn't done that. And so I think one of the things that Canadians are very forgiving about is mistakes that you make. So the first time he couldn't speak French, they'd be fairly forgiving about that and willing to let it go because he promised that he would do better. So now we're facing a situation where he has not done that, and he has not fulfilled his legal obligation. And then just to make it even more troublesome, one of the pilots who was tragically killed was a French Canadian.
Was French speaking. Okay, so let's take a look at the apology from the CEO, who said he didn't feel proficient in French to deliver that kind of message. We'll put it up on the screen in just a moment. I want to get your response to this. Was it enough? Did it go far enough?
No, I mean, I don't understand how this excuse that they've given is very puzzling to me, because they say he doesn't have the ability to express himself well enough in French. Well, nobody is asking him to do it extemporaneously. People are asking him to read a statement. And sure, his accent would be terrible, and sure, it would be difficult for him to do. But I don't understand how he can't read off a sheet of paper a short, brief, concise, and sincere statement. It doesn't make sense to me.
Okay.
I can see where he can't go on a radio call-in show, or he can't go on Tout le monde en parle or something like that and speak extemporaneously. But can't he read a sheet of paper?
Yeah, your point was also this was a controlled situation. They were putting out a comment online. Right. He wasn't in front of live reporters, for example, where he would have to answer in French. Okay, so let's put you in the position of advising this company. He has also gone on to say he's sorry that this is distracting from actually what took place with the accident. What would you advise Air Canada to do right now in reparation somehow?
So I think that they're in a very tricky position, and their board is in a very tricky position, because one of the things that we know about these situations is the way that you put an end to them, the way you cauterize them, if you like, is by resignation. And that the longer you let these things go on without coming to that solution, the bigger the problem that you have. So on the one hand, the quickest way to put an end to this solution is to accept his resignation, to move on, and hire a CEO who is bilingual. Now, that's pretty tough medicine, right? That's pretty rough justice, if you like. And so if you don't want to do that, you've got to figure out what is it that you're going to say, what is it you're going to do that's actually going to be meaningful. And that's where you're in really tricky water, and you're on very thin ice, because he's already said before that he would do what needed to be done, which was to learn adequate French, and he didn't do it. So how is he going to apologize for that, how he's going to make that right, how he's going to say, it's the old expression, first time, shame on you, second time, shame on me. So if Canadians took him at face value and said, okay, fine, an executive, busy, whatever, but, he did say he lived in Montreal for, I think, if my memory's right, 14 years, didn't have to speak French. Well, he does if he wants to run Air Canada. So what is he going to do short of a resignation? And that's where I'm not sure there's an answer. And when you see the political class, the Prime Minister, leaders in Quebec and so on calling for his resignation, I think he's in a tough spot. One thing we do know about that is that if he is going to resign, the quicker he does it, the better it is for him, as well as for the organization.
As you say, the calls for his resignation seem to be growing, and they started after the strike by Air Canada workers, which paralyzed travel around the world. All right, Jamie Watt, I got to leave it there, so thank you so much for your time.
Pleasure.
Coming up next, SpaceX mega IPO on the launch pad. More in a moment. Time now for Hot Picks. We zeroed in on the software sector, and we were joined by Rishi Jaluria, Managing Director in Software at RBC Capital Markets. We kick things off with his first pick, MongoDB.
MongoDB is a really interesting one, especially as we think about navigating this new AI world that we're entering in. So MongoDB it's open source, but it's under a different license methodology. But more importantly, it's really built for unstructured data. And if we think, what does AI create a lot of? It's unstructured data, right? Stuff that doesn't neatly fit into rows and columns. And we really think that MongoDB is well positioned to kind of draft off that tailwind of the development of these net new AI applications, especially those leveraging unstructured data, and it can be that developer platform of choice. And I think that's the reason why you're seeing all these AI native companies really moving towards MongoDB. Anthropic uses them, Cursor uses them, Relevance AI. There's a number of other ones out there that are using MongoDB today, and we think that footprint is going to continue to grow.
Interesting. Your next one is Intuit. What is it that you like about this software company?
Yeah, Intuit's a really controversial one right now with AI, and I think squarely in the kind of crosshairs. And look, on the core TurboTax and QuickBooks franchises, on TurboTax, there's always worries of, can people basically replicate or vibe code their own version of tax software? But what I would say is this, the stakes are very high, right? If you do something wrong with your taxes, you get audited by the IRS or equivalent organization. There's a lot of workflow that's important in this. And even with kind of the worries of, okay, at the low end, can people use AI to maybe hold their hand during the process? To me, that undersells the major opportunity that QuickBooks has in AI. In the near term, it's integrating that AI experience with all the data, domain, and workflow expertise that Intuit has on tax filings to make the experience more seamless. And to me, that's TAM expansive. And then maybe in the longer term, call it 3 to 5 years, is there the opportunity for Intuit to develop AI agents that can do simple tax filings for you? I think the answer to that is yes. And again, that's monetizable and it's TAM expansive, especially when you think of just how large the market for assisted tax out there is. And then I would say a similar theory on the QuickBooks side. With QuickBooks, I was talking about TurboTax, but on the QuickBooks side, that's accounting for small businesses. This is, again, very mission critical software. It's difficult to replicate. And I think there's a huge opportunity for AI in there, again, going after services. If I'm a small business and I'm paying an external accountant, in 3 to 5 years, can Intuit just kind of capture that market leveraging AI? I think the answer to that is yes.
It seems as though these three companies all have something in common, which is really ramping up their development of AI assistants, AI agents, and that seems to be the same story for HubSpot, which is your last hot pick.
Yeah, look, I think that's a great observation, and common thread between the names I like is actually innovation. I mean, we could talk about data and enterprise versus SMB, but really innovation is probably the most important mode out there in software as you're dealing with the paradigm shift of AI. And with HubSpot, I would say the same thing. HubSpot, it's a CRM company, so they do marketing, sales, commerce, operations, service. But in contrast to others in the space, HubSpot is built entirely organically. So all these different hubs that they built were all built on the same platform, which means a single data record, single user experience. And, I think HubSpot, especially under the leadership of CTO and co-founder Dharmesh Shah, has been very AI forward in their roadmap. I mean, I subscribe to Dharmesh Shah's newsletter. He is probably more hands-on with AI than any public company exec I see, at least in this market cap range. And so I feel good about their ability to integrate AI through that sales and marketing experience. And even if we're going to go into a world where we're going to face headcount reductions because of AI, I think HubSpot can offer a lot of innovation on top of AI that they can monetize in a mixed model or a consumptive model that ultimately ends up being, again, expansive to revenue and maybe even drives revenue acceleration.
It's so interesting what we've been seeing with the software sector this year, that sell-off that we saw. I can't remember whether that was January or February, but that real sharp sell-off. And now we're starting to see some of these companies coming back, right? Like, do you agree with the assessment that there's some companies, and maybe these are them, that will benefit from AI, and then there's some that really, if they're not innovating, as you say, could become redundant because of the advancements in AI?
I think that's exactly right. Like, I think, general consensus is the sell-off was probably too sharp, but we almost see a little bit of a K-shaped recovery coming out of this, right? And you said the sell-off back in January, February. I mean, we're going to see continued sell-offs as, Anthropic makes new announcements, OpenAI makes new announcements, Google makes them. But, really, I think it's these innovative companies that can truly be AI beneficiaries that we think could be, a double or a triple or so on over the next several years from here versus a name that, maybe might bounce 20, 30% off the bottom. And really, I think it's doubling down on, innovation and customer success. That's going to really matter more than anything, especially if we're dealing with this new paradigm. We have new platforms out there. We've got, trillions of dollars of venture funding going into AI native companies. I think that's exactly it.
Do you think we could be seeing more of these sharp sell-offs, though, throughout the year if there's other innovation coming out there?
I think yes and no, right? Like, I think, to a certain extent, I think maybe some of the most draconian situations are already out there of, job losses and what happens to all of these companies. So that's on one hand, maybe the worst is already out there. But, as we saw when Claude came out with Claude Desktop earlier this week, right, it did contribute to a continued sell-off in software along with some of the private credit news and a few other things out there. There's just a number of factors. So, there's potential for continued sell-off, but I would say so many of these software names are trading at such cheap multiples, even on GAAP earnings, that it's hard for me to say that, a sustained sharp sell-off, right, won't have a bounce back. And at the same time, I think if a lot of these companies can actually show real acceleration in growth towards the end of the year, it becomes harder and harder to underwrite that AI bear case, that if a company is actually accelerating growth, well, then maybe the AI bear case isn't accurate. So that's kind of where I think about it. I hesitate to call a bottom. No one has ever successfully called one. But to a certain extent, from a narrative perspective, at least, it feels like the worst is behind us.
Rishi Jaluria, Managing Director in Software at RBC Capital Markets. The war in the Middle East continues to take markets and consumers on a wild ride. And as CTV's Scott Hurst explains, even if there is a quick resolution, it could be some time before prices level off.
More volatility at the pumps. The price of fuel continues to take so many of us on a roller coaster ride. Up one day, down the next. The Canadian average stood at about $1.73 per litre as of Thursday morning, up about 3 cents from just the day before. Of course, the price can vary greatly depending on where you fill up across the country. The wild swings are impacted by so much uncertainty about the U.S.-Israeli war with Iran, or whether or not the bombing continues or if a peace plan can be reached. But even if there is a diplomatic solution soon, it could still be a while before prices stabilize.
I think we're going to see the elevated price for quite some time, even if excursion war, whatever Trump wants to call it, were to end fairly soon. We've had a lot of damage to the infrastructure, and there's going to be a lot of time before we're going to have the refineries producing and then shipping for home use. So this is going to last, maybe not higher, but at least at these elevated levels for months, if not even for 6 months.
On average, according to CAA, prices at the pump are still up 35 to 40 cents per litre over the past month. Scott Hurst, CTV News, Toronto.
All right, a quick look at how we ended the day. It was a sea of red for North American markets. Big drop for the TSX, down 1.5%. S&P down 1.7%. The NASDAQ over 2 down. Thanks for joining us on The Close. We'll see you back here tomorrow.